Okay, so let's jump right in. Today we're diving into something that caught my eye, a pretty major economic shift coming out of Nigeria.
Yeah, this one's interesting.
It's the sudden halt of their naira-for-crude oil swap deal. We're digging into this based on some excerpts from an article called Nigeria Ends Naira for Crude Oil Swap. And we're going beyond just, what happened to really figure out the why behind it.
Right.
So, why was a swap put in place in the first place? What led to its pretty abrupt cancellation? And what does this all signal for, well, for you, really, anyone following global economic trends?
Definitely. Like knowing something happened is one thing, but understanding the mechanics behind it and where things might go from here, that's where after. So to start, what exactly was this Naira for crude swap all about?
Okay, so the article tells us this deal kicked off on October 1st, 2024. And it was kind of a unique approach. Basically, instead of buying and selling crude oil in US dollars, which is how it's typically done, this swap allowed domestic oil refiners in Nigeria. They specifically mentioned the Dangote Refinery and some other private companies to buy their crude using their local currency, the Naira.
Interesting. So what was the thinking there? What were they hoping to achieve by moving away from the usual dollar-based transaction?
Yeah, there were a few key goals. First, it was about boosting Nigeria's own capacity to refine oil. Make it easier for local refineries to get the crude they need in Nigeria. And the idea is that that would then encourage them to produce more gasoline, diesel, and other petroleum products right there in Nigeria.
Makes sense.
And that kind of leads into the second objective, which was reducing Nigeria's reliance on fuel imports. If their refineries could produce more domestically, they wouldn't need to spend as much of their foreign currency reserves on importing refined fuels from other countries.
Got it. So boosting domestic production, cutting down on imports, and all of that then ties into the third aim, trying to stabilize the value of the Naira itself.
Exactly. If these refiners could buy their crude in Naira, they wouldn't need as many US dollars, right?
Hmm.
So theoretically, that decreased demand for dollars would take some of the pressure off Nigeria's foreign exchange reserves, potentially strengthening the naira in the process.
Yeah, I see how that would create a sort of ripple effect.
Right. It's about energy security and just broader economic health for Nigeria.
So given these pretty ambitious aims, what caused this pretty sudden about face? Why terminate the agreement so abruptly?
Well, the article points out that the suspension was effective immediately, which does suggest it wasn't a planned phase out. And the main reason they give is really what makes this whole thing so fascinating. Apparently, the NNPC, the Nigerian National Petroleum Company Limited, told these domestic refiners that they'd already committed all of their crude oil production to something called forward contracts.
Forward contracts. So they've basically pre-sold all the oil they're going to produce for a set period.
Exactly. And according to the article, these pre-existing agreements mean there's simply no crude left to supply the refineries that were part of that Naira for crude arrangement.
Okay, but here's where it gets even more interesting. The article mentions that this news comes right after reports suggesting that Nigeria has actually been producing more crude oil overall since they launched this swap back in October. So on the surface, it seems kind of contradictory, right? They're producing more, but somehow there's none left for their own refineries that were supposed to be paying in Naira.
Right, yeah. It definitely raises some questions about these forward contracts. Who are they with? What are the terms? How long do they last? And more importantly, why would they take priority over supplying those domestic refineries? Especially when you think about the whole point of the Naira for Crude initiative. It seems like there might be a bit of a clash between short-term obligations and longer-term strategic goals for Nigeria's economy.
Yeah, it does seem like there's more to the story here. But regardless of the exact reasons, the bottom line is that Nigerian refineries, including that big Dangote facility that everyone's been watching, now they have to go back to getting their crude from international suppliers and paying for it in US dollars.
Which brings us to the likely consequences. The article highlights a couple of big ones.
Yeah.
The most immediate impact is probably going to be higher operating costs for these refineries. They're back to dealing with exchange rate fluctuations and potentially higher prices on the international market, which is inevitably going to push their expenses up.
And for the everyday person in Nigeria, someone who might be listening to this right now, that translates to one very real possibility: higher fuel prices.
Right. If the refineries are paying more to get the crude, there's a good chance they're going to pass those costs on to consumers. It's a real-world example of how big economic decisions can trickle down and impact your wallet.
So let's recap. Nigeria put this naira-for-crude swap into play in October 2024 with the goal of increasing their domestic refining capacity, reducing their need to import fuel, and stabilizing their currency.
But just a few months later, the deal's off. The reason given is that the NNPC already pre-sold all their crude through these forward contracts, meaning there's none left for the refineries that were supposed to be part of this naira-based system. And this, despite reports that Nigeria's been pumping out more oil since the swap started.
And now those refiners are back to buying in dollars, which is likely to mean higher operating costs for them and potentially higher fuel prices for consumers.
So the big question is, given all of that, what does this mean for Nigeria going forward? The swap was supposed to be about energy independence and a stronger currency. But now they're prioritizing these forward sales agreements, which might actually undermine those very goals. So were those contracts really the best move? And what other factors might be at play here? The article doesn't really get into it, but could there be some geopolitical maneuvering going on behind the scenes with those forward contracts? Or are there crucial details hidden within the terms of those agreements that we just don't know about? It really makes you think about the complex web of energy resources, global markets, and national currencies.
Definitely a lot to unpack there and a lot to keep an eye on as the situation develops.
That's